Preemptive rolling. A nice aspect of the wheel is if we decide we want to alter the trade position, all that's required is a simple roll. This is usually done in the last week to expiration after most of the time value gain has been garnered, but might be done earlier if the overall credit for doing a roll is good. Rolling is the closing of one trade whilst opening another in a single trade order. It's effectively what we intend doing as a successful current trade nears its end. Closing the winning trade, then opening a new one, perhaps in that case though, against another stock. The best roll is one which largely maintains the trade's income goal, whilst adjusting the trade into a more favorable, in our opinion, position. Rolls are about making discretionary decisions, which may also validly be done to make us feel more comfortable about the trade position. Short puts and calls can be rolled up or down and strike or out in time to a later expiration date. It's best not to roll so far out in time that any credit for doing so is poor, by the 30 DTE benchmark, or to be locked into holding the position for too long, more than 45 DTE. A roll for a price we like today is better than closing a trade today and betting on opening a trade on the same stock tomorrow, which risks price no longer being at the level we liked and running further away on us. Rolling a sold put down to a lower strike. If we really have confidence in the underlying stock as we should have when deciding to trade it. Being assigned is no bad thing, but a business's circumstance can change on disappointing or negative news, and we may decide to protect the downside risk of a falling stock price by moving the potential assignment strike lower. Rolling down in the current expiration cycle will be at a cost that'll reduce the original premium taken and may even require rolling out in time. Also, if eventually assigned at the lower strike, being closer to the money than we would have prior to rolling, we'll be more likely able to sell CC. Rolling a sold put out to a later expiration date. A sold put may end up ITM, which means we're at risk of assignment at expiration. However, since all options carry time value and theta decay continues regardless, an ITM put option can be rolled out to a later expiry date to collect more time premium on the roll and also defer or ultimately potentially avoid assignment. Puts usually carry a little more time premium than calls from IV. Being more skewed towards puts, risk, fear, and covered call pricing may be depressed from the stock's down move, so we might prefer to roll the put out in time where rolling the put pays more premium than the CC that we might have written had we chosen assignment instead. When rolling a put, we know that we're doing it for an acceptable price right now. If choosing to take assignment, which will be actioned post Friday's market close, the assigned stock doesn't show up in the portfolio until Monday's open, risking a weekend's news events and potential adverse price direction risk, where the CC right that we had planned for Monday might no longer be viable at Monday's open. It's also generally best not to have to trade the market open, especially if feeling pressured to place a trade, because for up to an hour or so, option pricing is usually more volatile and uncertain, and the risk of taking poor pricing is heightened when trading the open. Rolling a sold call up to a higher strike. A roll on a CC position might be a bet on being called away higher for an intrinsic stock price gain at the higher strike price. Playing for intrinsic gains on stock price when bullish on a stock's likely price performance can really juice returns if it comes off, but the outcome is binary. Either the bet on stock price movement works out, or maybe we miss the chance to be called away at the original lower strike and risk further price retracement, reversal on the stock. Moreover, rolling up in the same expiration cycle is going to cost premium return. Doing the roll for an acceptable credit or to avoid an unacceptable debit may require also rolling out to a later expiration. More time in market is more risk of price reversion against the trade. When holding stock, there's always the risk of price falling to a point where ongoing CC rights become unviable, so a preference to being called away over betting on a higher strike for intrinsic gain may be the safer way to go, because CC rights aren't always on, but the next CSP trade on a multiple choice of stocks is always available. Rolling a sold call out to a later expiration date. When stock price is trending sideways between support and resistance levels below the equivalent strike, rolling out calls to a later expiry when the chance arises to make a worthwhile right of at least 2.5% premium for the roll keeps income rolling in. If stock price falls, the chance to sell CC premium may be gone, so it may be better to take the opportunity to roll a CC forward when it arises.